Here's something that sounds impossible. A 25-year-old college dropout is collecting more monthly income from dividends than many people make working full-time jobs. Meanwhile, seasoned investors with decades of experience are barely earning enough to cover their coffee expenses. The difference isn't luck, timing, or insider knowledge. It's understanding exactly what a strategic $5,000 dividend portfolio can actually pay you every single month, and why most people are building theirs completely wrong. What you're about to discover will challenge everything you thought you knew about dividend investing, because the real numbers behind a properly constructed $5,000 dividend portfolio are nothing like what the financial industry wants you to believe. Before diving into the real numbers, there's a massive misconception that needs to be destroyed. Most people think dividend investing is boring, slow, and only for retirees who are satisfied with tiny returns. They picture dividend portfolios as collections of ancient utility stocks paying 2% yields that barely keep up with inflation. This couldn't be further from the truth. The reality is that a strategically built $5,000 dividend portfolio can eventually generate monthly income that rivals what many people make from their jobs, and it keeps growing every single year without requiring any additional work. But here's the catch: not all dividend portfolios are created equal. The difference between a mediocre dividend portfolio and a wealth-building machine comes down to understanding three critical factors that separate the amateurs from the professionals. The most successful dividend investors don't just randomly buy dividend-paying stocks. They use a systematic approach that balances current income with long-term growth, creating a portfolio that pays well today while building wealth for tomorrow. The foundation of any serious dividend portfolio consists of dividend-focused ETFs that provide instant diversification and professional management. The two powerhouses that dominate this space are SCHD and VYM. SCHD, the Schwab US Dividend Equity ETF, currently yields around 3.5% and holds 103 high-quality dividend-paying companies. But what makes SCHD special is its dividend growth. SCHD's dividend growth averages an incredible 12.2% per year, meaning the income grows substantially over time. VYM, Vanguard's high dividend yield ETF, provides broader market exposure with a focus on high-yielding large-cap companies. With a yield around 3.2% and holdings in over 400 companies, VYM offers stability and consistent income generation. Together, these ETFs form an unshakable foundation that generates steady income while providing exposure to hundreds of dividend-paying companies across multiple sectors. The second bucket focuses on individual dividend aristocrats, companies that have increased their dividends for 25 consecutive years or more. These are the elite performers that have proven their ability to generate cash and reward shareholders through multiple economic cycles. Johnson & Johnson is a healthcare giant with 61 years of consecutive dividend increases, even through multiple recessions and market crashes. Procter & Gamble, the consumer goods powerhouse behind brands like Tide, Gillette, and Crest, has increased its dividend for 67 consecutive years. Its products are recession-proof, making P&G's dividend one of the most reliable income streams available. Coca-Cola, Warren Buffett's favorite dividend stock, has raised its dividend for 61 consecutive years. The company's global reach and brand recognition create a moat that protects its dividend-paying ability. PepsiCo combines beverages and snacks in a diversified portfolio that has supported 51 years of consecutive dividend increases. From Pepsi to Frito-Lay, the company's products are recession-resistant staples. Realty Income, known as the monthly dividend company, pays dividends 12 times per year instead of the typical 4. This REIT has increased its dividend for over 25 years while providing monthly income that helps smooth out cash flow. The final bucket contains companies that don't pay high yields today but are growing their dividends aggressively. These are the future dividend powerhouses that could become the aristocrats of tomorrow. Microsoft, despite its relatively low yield of around 0.7%, has been increasing its dividend by double-digit percentages annually. The company's high-margin software business generates massive cash flows that support aggressive dividend growth. Apple, with a yield around 0.5%, might seem like an odd choice for a dividend portfolio, but the company's $162 billion cash hoard and commitment to returning capital to shareholders through dividends and buybacks makes it a powerful long-term holding. Starbucks rounds out this bucket with a yield around 2.1% and a track record of consistent dividend increases. The company's global footprint and brand loyalty create a foundation for continued dividend growth. Now for the moment of truth, what does a $5,000 portfolio allocated using this 3-bucket strategy actually pay each month? We're putting $500 in 10 stocks. The historical yield growth of a portfolio of these 10 stocks averages around 7% annually. We are using DRIP, and we will also assume we bought before the ex-dividend date for January payouts. Month 1, January, the New Year's hangover. We start the year off slowly with only 2 companies paying dividends, PepsiCo and Realty Income. PepsiCo paid $3.88 and Realty Income paid $2.38. January's total, $6.26. Month 2, February, fruit and coffee arrive. February brings the first quarterly payments from Starbucks, Apple, and P&G. Starbucks paid $3.25 and Apple paid 33 cents. We also collected $3 from P&G and Realty Income's monthly dividend of $2.38. February's total, $9.26. Month 3, March, we welcome the ETFs. March brings our first ETF payments. March saw SCHD pay $4.63 and VYM pay $4. Johnson & Johnson paid $4.13, Microsoft paid 88 cents, and we collected another $2.38 from Realty Income. March's total, $16.02. Month 4, April, consumer staples kick in. In April, we collected another $3 from P&G and $4 from Coca-Cola. We also collected $2.38 from Realty Income. April's total, $9.38. Month 5, May, Starbucks and Apple return. Starbucks paid us $3.25 and Apple kicked in 33 cents in May. We also collected $2.38 from Realty Income. May's total, $6.26. Month 6, June, a big month. June is a big month with PepsiCo, SCHD, VYM, Johnson & Johnson, Microsoft, and Realty Income all paying. PepsiCo paid $3.88. SCHD paid $4.63. VYM paid $4. J&J paid $4.13. Microsoft paid 88 cents. And Realty Income paid $2.38. June's total, $19.90. That brings our 6-month total to $67.08 in dividends. Over the first 6 months, this $5,000 dividend portfolio generated over $67 in dividend income. That averages out to approximately $11 per month, which might seem modest at first glance. But here's where the magic of dividend investing becomes apparent. This is just the beginning. The real power of dividend investing isn't in the initial payments, it's in the compound growth that happens when those dividends are automatically reinvested through DRIP or dividend reinvestment plans. Every dividend payment automatically purchases more shares. Those new shares generate additional dividends, which purchase even more shares. This creates a snowball effect that accelerates wealth building over time. The first year, annual dividend income from this $5,000 portfolio would be just under $150. While this represents a yield of about 3.1%, the real story is in the growth trajectory. With dividend growth averaging 12.2% annually for SCHD and similar growth rates across the other positions, plus the compounding effect of reinvested dividends, the portfolio could be generating over $250 annually by year 5. By year 10, the combination of dividend growth and reinvestment could push annual income to over $400. And after 2 decades of dividend growth and reinvestment, the original $5,000 could be generating almost $1,100 annually in dividend income, with the portfolio value having grown substantially beyond the initial investment. While starting with $5,000 provides a solid foundation, there are several strategies to accelerate the dividend income timeline. Adding just $200 per month to the portfolio can dramatically accelerate growth. This additional capital, combined with reinvested dividends, could push the portfolio to generate an additional $100 or more monthly within 10 to 15 years. Tax refunds, bonuses, and other windfalls can be immediately deployed into the dividend portfolio for instant acceleration. A $3,000 tax refund invested in the portfolio could add $20 to $30 in annual dividend income immediately. Cutting one major monthly expense, perhaps a $150 cable bill or a $200 car payment, and redirecting that money to dividend investments can also cut years off the timeline to meaningful monthly income. It's important to set realistic expectations about dividend investing. A $5,000 portfolio generating around $13 per month in year one isn't going to replace anyone's salary immediately. This is a long-term wealth-building strategy that requires patience and consistency. However, the power of this approach becomes clear when you consider the trajectory. What starts as $13 per month can grow to $50 per month, then $200 per month, and eventually to substantial monthly income that could supplement or even replace employment income. The key is understanding that dividend investing is about building a machine that pays you whether you work or not. Every dividend payment is a step toward financial independence, and every reinvested dividend accelerates the journey. Start with $5,000 as soon as you can, add money when you can, and let drip, compounding, and time do the heavy lifting. I need to warn you that many dividend investors sabotage their success by making some critical errors. Mistakes like chasing high yields, taking dividends as cash, failing to diversify, or plain old impatience. You need to understand that sustainable dividend growth is more valuable than unsustainable high yields. That compound growth from reinvestment is where the real wealth building happens. Failing to diversify creates too much risk, and impatience can prevent compound growth from working its magic. Don't make these mistakes. The numbers don't lie. A strategically constructed $5,000 dividend portfolio can generate meaningful monthly income that grows over time. While $13 per month might not seem life-changing, it represents the foundation of a wealth-building system that could eventually generate hundreds or thousands of dollars monthly. The most successful dividend investors understand that this isn't about getting rich quick. It's about building a reliable income stream that works whether the stock market is up or down, whether the economy is booming or struggling, and whether you're working or retired. Start as soon as you can with what you can. Every month you delay is another month of potential dividend growth lost forever. What's your biggest question about building a dividend portfolio? Drop it in the comments below and let's discuss the strategies that could help you start generating monthly dividend income. If this breakdown opened your eyes to what's possible with dividend investing, hit that subscribe button for more real-world wealth-building strategies that actually work. We publish fresh content every week. See you on the next one.